In this video, guys, we're going to look at different ways to get exposure to crude oil. Stay tuned. Hey traders, warm welcome to you. All right, so time of filming this video, crude oil is very volatile. In fact, it's so volatile, it's being hammered, but we have times, of course, when it is going crazy through the roof. It has different periods, right? Same with any market. You have stagnation, then all of a sudden some sort of news comes out that really affects the supply demand of the underlying asset, and it really starts going crazy. So what different vehicles can we use to get exposure to crude oil, either from the long side or either from the short side? So the first kind of pure exposure, if you like, would be via the futures contract. By the way, this is West Texas Intermediate I'm talking about. You've got other different grades, Brent, etc., but just keeping it with the West Texas Intermediate just because that's the one that happens to be super spicy at the moment. So CL and QM. So CL is the big boy contract. It's the one that all the producers and consumers trade. You've got multiple months you can select, whether you want a far month expiry or near month expiry. QM is a kind of mini version. It's a slightly smaller contract, really for speculators and those with smaller accounts. CL can be quite a big contract if you only got a small account, which is the downside. So the QM will track it, but there's a slightly wider spread in it, even though the tick size is a little bit lower and the margin requirements are a little bit lower. Now, be very careful with crude oil because it can actually trade at a negative price. Unlike many other assets that can only go to zero, crude oil can actually go negative. So you have to be aware of that with your risk management. Even if you think it's really low, it's not necessarily as low as it could go. It can go almost infinitely lower. So be careful when you're trading that, and also be careful about your expiry. Make sure that you're closing the position way before expiry. Guys, most retail brokers won't let you take delivery of crude oil. It's locked into that, but you might be with an unusual broker that hasn't got that setting, but I can't think of why they would ever do that. But you need to be aware that you're actually buying a product that you will get delivered if you have expiry. You have to pay the full price for it and it'll be delivered. But I don't know anybody personally, I've heard stories, of course, if that's happened to people, not anyone personally that's happened to, and most brokers will shut you out of the position literally just as a default setting because they know that 99.999% of people do not want delivery of crude oil. So trading via the futures contract. Then you've got the ETFs. Now there's a lot of ETFs out there, different instruments, different exposures. You've got inverse, you've got triple leverage, double leverage, etc. But the main one is USO. Now, you've got to be very careful with ETFs as well, guys. I've got to real warn you with ETFs because you're trading a product that is someone has kind of put together in a wrapper and presented to you and said, hey, this is what we're trying to track, this is how it works. There are stories where ETFs have just gone to zero and that means everyone's lost their money. I know specifically with USO at the moment, there's a lot of differences going on how they're tracking the price of crude oil. So you've got USO, UCO is another one. There's loads out there, guys, and I will do another video specifically on the ETFs of crude oil. If you're interested in that, make sure you're subscribed and all that other good stuff. But that's one way of getting exposure to crude oil. It's not going to be directly to just 1 month. It's not going to be directly to the front month because these tend to have a blend of various different months exposure, but it's some way of getting exposure. If you want pure exposure to a specific crude oil delivery month, futures contract is the way to do it. Right, talking about that, if you've got a CFD account or a Spreadbet account, by the way, check out our channel sponsors. I linked them in the description below if you're interested in something like this. These will track the futures price, and you can most of the time with a lot of them you can trade that futures contract. So you can trade the futures price, it will just mirror that, but it will wrapped up as a CFD or wrapped up as a spread bet. So that's a good way for many people to get exposure without having to pay the full price of the futures contract, because it can be a bit big for smaller accounts because of the way it moves and the tick value. Whereas if you're trying to CFD or a spread bet, you can normally shrink it down so you get a little bit less price movements per tick, so you can control your risk a little bit better. So the futures contract is the kind of pure mirror of CL on this one. Now many of them will offer a cash product, and now with a futures contract you've got a wider spread, but it won't expire until it comes to the actual expiry of the futures contract. Cash never expires, it rolls over each night and you pay a little bit of a rollover spread each night to hold that, a holding charge. So well, actually, it's wrapped up in either or, guys. You have to pay your holding charge to hold over it each night, which is effectively the spread. So how does that calculate? Now, each company is different, but it's basically a blend of the different futures contracts prices. So they might have X% of front month, X% of the next month, X% of that month. So they're trying to get a reasonable representation of multiple different contracts, got futures contracts moving. So you've got to be careful with that and kind of a little bit of understanding what you're trading, how it works, what happens if one of the futures contracts goes through zero, all these kind of things. So again, with any of these products, guys, specifically at the moment when I'm filming this, be very mindful about the product you're trading, because it's your responsibility to make sure that product is suitable for what you're trying to achieve in your thesis. So, okay, CFD, spread bet, you got the cash or the futures contract. Now, options. Options you can trade either on the futures contract itself, which it can be a bit tricky because of the expiries and this, and I would say it's not something for a beginner trader to look at, because you're trading an option on a futures contract, so you've got an option expiry and you've got a futures expiry. There's lots of things that go into that. You can trade an option on the ETF. So if you're trading on USO, for example, which is one of the biggest ones at the moment, this might change, guys, by the time I finish filming this. There's so much going on with this Pacific ETF. But if you trade an option on the ETF, it's super liquid. USO has been super liquid, and I'm sure everyone's a USO, there'll be another ETF that comes up. It allows you to trade basically, an ETF kind of is almost like a stock, for want of a better word. The way it trades is like a stock. So you can trade an option, put option or call option on that actual ETF. And then the other thing you could do, guys, is trade an option on a stock. So we'll look at these in a moment. So some kind of proxies, if you like, for crude oil, if you don't have direct exposure to crude oil, is to buy a company that's reliant on crude oil in one way or another. So you think about the producers, like the big guys like Shell, BP, Exxon, etc., all those that you're aware of, these are going to be affected by the price of crude oil. Not solely, but a lot, especially when you're going to pure kind of producers like this. If you want to go downstream a little bit, you've got some smaller drilling companies potentially, or some companies that maybe are involved in supplying the equipment, that kind of stuff. Obviously if crude oil starts to pick up and demand picks up, these guys will get more business, so they'll make more money from that. So that's a kind of a proxy play. And then on the other side of the equation, you've got the consumers of crude oil, which are generally people who are using fuel. So airlines is a big one. Now, when I'm filming this, guys, everything's been locked down, so airlines aren't really consuming fuel anyway. But regardless of that, that's the situation. If you think the oil price is headed lower, airlines will generally benefit. It's not always as simple as that, because very often they will hedge their exposure. So they'll hedge the cost of their fuel for a certain number of quarters or years or whatever it may be, and they may not benefit in the very short term from that. Some of them have different, it's a commercial decision they make, guys, isn't it, ultimately, whether they hedge and how much they hedge. So be aware of that. Shipping as well, again, using a lot of fuel. Transportation, so anything that's actually using a fuel, it will generally, in the longer term, benefit from a lower crude oil. But also bear in mind, often a lower crude oil price can be indicative of a weaker economy. Not always, but can be indicative of a weaker economy, which also could have a knock-on effect to these guys who, the consumers aren't actually using the airlines, the shipping, the transportation. So it's not always as clear cut, but it's some way of getting exposure to crude oil on a kind of proxy basis. You're not getting pure exposure, but you're getting a different type of exposure. So trading the futures contract directly, trading it via an ETF, CFD or Spreadbet, check out our channel sponsor. We've got a link to those in the description below. Trading an option on the futures contract or on the ETF or on one of these stocks, the producers and consumers, and there's plenty of these as well to choose from. So different ways to trade crude oil. Take care, guys, and keep risk managed, and make sure you understand the product that you're trading, because there are little nuances with a lot of these that you need to be aware of. Take care. Bye-bye.